Today, we're going to be talking about Vanguard's prediction ratio. Now, we're going to discuss what exactly is a prediction ratio and how can we use it to make better decisions as long-term investors. So let's get started. This chart here from Vanguard, it's got an upper range, it's got a lower range, and then in the middle is this brown line. This is Vanguard's prediction ratio. So what exactly is a prediction ratio? That is giving a fair value estimate, and in this case, it's Vanguard giving a fair value estimate when comparing growth versus value in terms of being expensive or cheap. And so what this means is when the line is going positive or above the high range, it means value is getting pretty expensive relative to growth. And when the line goes down below the low range, it's saying that value is pretty cheap relative to growth. And what this is doing, this prediction ratio is giving this middle number, but it's also giving you this band because things change over time and nothing is exact when it comes to investing, in particular when it comes to predicting the future. And so what this does, it gives us a range and a way to just think about what's expensive relative to other asset classes, because as we've discussed before, the more you pay for an asset, all else being equal, the lower your expected rate of return. And so when you're looking at your portfolio, are you buying expensive assets? Or said another way, are you paying a lot for future cash flows? Or are you buying less expensive assets and paying less for future cash flows? And let's look at the chart a little more specifically, because right now the line is low. Now, what does that mean? Remember, when the line is low, that means that value is relatively cheap compared to growth. Okay, it's relatively cheap compared to growth. What does that mean for us from a number standpoint if you were to look back in history? Well, let's look at the last time we had a pretty big dip in this chart, and that was going back to 2000. And value was, again, pretty cheap compared to growth, and it was about 50% cheaper, roughly, than growth was. And what happened? Well, the line starts to go back up to its prediction ratio. Now, why is that? Right? Vanguard does not know something that others don't, but what they're saying is, hey, things trade in a range over time, and when it starts to get out of a range, you can expect things to start coming back in line just based on the price you're paying for assets. And so going back to this chart that we're looking at, when you have the number or the line drop incredibly low, what does it look like to come back to normal? And in these cases, coming back to normal meant double digits. And in this case, 30, 40, and 50% returns in excess of the other asset class. So said another way, when value came back to normal, it outperformed growth by 40 and 50%, just getting back to normal. Now, where are we today? Today, as you can see, this line is low. It's below the band. And so while Vanguard, again, is not predicting the future, what they are saying is it would not be surprising for value to come back up to something in its prediction ratio range. And what would that mean? Well, if you look at the numbers right now, it's trading at a discount to its prediction ratio of between 40 and 50%. And so it's pretty easy math to figure out, well, what does that look like just for it to get back to normal? Not for it to become overpriced, not for it to become expensive relative to growth investing, just to come back to normal. It has to get back through a 40 to 50% discount. And if you're a value investor, that would be a pretty good thing to participate in. And so what Vanguard is not doing and what no one is doing is saying, this is what you can expect in the next few months or the next year or any time in the future, because again, you can't really do that as far as the market goes. But it gives us context when you're buying expensive assets versus inexpensive assets and realizing when things start to go out of a normal range, just to get back to normal, just to get back to a historical normal range can be pretty profitable if you're on the right side of it. And sometimes all it takes to be on the right side of it is knowing where you stand in the first place. And so looking at this prediction ratio, you can use this for all different asset classes and say, what am I paying for these assets? Is this cheap relative to history? Is this expensive relative to history? What side am I on? And if I'm on the expensive relative to history side, that's okay as long as you have a reason. And as long as you have a hypothesis and facts that you say, I feel comfortable with where I am and the future expected rate of returns. But you can use this prediction ratio that Vanguard's got and say, with my long-term portfolio, am I set up how I want to be? And am I in the right spot of this curve? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.